Breaking news, one of the three big ratings institutions, Fitch, downgraded U.S. debt. I'm sure you heard of this already, but you may not know what this means. I guarantee you this will be the best video that you watch on this. I will break this down for you. It's going to be beginner friendly, but also will give you insight if you already know what this means. And why did the indices immediately drop? NASDAQ is almost down 2%, S&P down 1.15%. And what are we expecting from this? The last time that this happened was back in 2011 by S&P. Yes, the same S&P in the famous S&P 500. They are also a rating system. There are three of them: Moody's, S&P, and Fitch. So the last time this happened, the market almost hit a bear market. We almost went back into a bear market after climbing out of the great financial crisis. This was in 2011. So we're going to get into this. What does it mean for the market? Are we expected to see a drop now? If you guys are fans of this channel already, you know that I try to keep you updated with as much relevant info as possible. And I try to make some of these more complex headlines, news stories, concepts more relatable so that the average person can better invest and trade on their own. So before we get into what this actually means, it's funny that a couple days ago, I already issued my analysis saying that we should be ready for a potential pullback in the summer. And I'm starting to think about hedging here. You could see the date on this. This was July 31st. So 2 days before this actually happened. I will get more into the market implications, but let's discuss this first. So what does it mean to downgrade U.S. debt? Are we talking about consumer debt? What are we talking about here? Well, U.S. debt means basically what the Treasury issues, right? So the U.S. government borrows money from us in exchange for Treasury. So say, for instance, we give the U.S. government $900, and by the end of the year, they'll give us back $1,000. So we are getting interest on the treasuries that we buy from the U.S. government. That is the U.S. debt. So normally the United States, being the world superpower, we have a AAA rating, the highest rating possible. Yesterday, we were downgraded to AA+. That is the next lowest rating under AAA. Now, this is still, if a country was rated AA+, it's still a very strong rating. However, for the U.S., which is supposed to be the beacon of finance in the world, to be downgraded for the second time, the first time happening in 2011, is one, a slap in the face to the U.S. government, and two, a slap in the face to the U.S. financial system. Now, let's see, is there any merit for this, right? Because this seemed like it was random. And the reason I say that is because the debt ceiling issue was resolved in May. It was resolved, I think, May 24th. So why in August is Fitch now downgrading U.S. debt? Well, let's hear from the horse's mouth themselves. This is on their website. The rating downgrade of the U.S. reflects the expected fiscal deterioration over the next 3 years, a high and growing general government debt burden, and the erosion of governance relative to AA and AAA rated peers over the last 2 decades that has manifested in repeated debt limit standoffs and last-minute resolutions. So just on the surface there, they are talking about governance here, right? They're not talking about the health of the U.S. They're talking about basically fiscal policy. See, there are two types of policies that we refer to when we talk about economics. There's monetary policy and fiscal policy. Monetary policy, you can largely bucket under the Fed's purview, right? That means interest rates and money supply. Fiscal policy refers to the government. So it refers to taxation and government spending. There are two ways that the government makes money. And the two ways is here. Let's just draw the government. This is the government here in this really fancy house. There are two ways that the government makes money or gets money for its spending, right? Taxes is one of them. That's the obvious one. The other one is by issuing debt. And remember, we said debt are in the form of treasuries and treasury-related securities, right? That is how the government makes money. Now, they can't get all their money from taxes because the U.S. spends a lot of money. Think about military programs and Social Security and, foreign aid and domestic aid, etc. So taxes doesn't cover it all. The rest has to come from debt. Now, we have a ceiling on how much or how many treasuries or how much debt the U.S. Treasury can actually issue. And that ceiling is set every few years. So when we hit that ceiling, right, imagine this is the debt ceiling, and we can't we can't get any more from taxes. We've maxed out on taxes. they've maxed out on the debt that they can issue because we've hit a ceiling. What do they need to do? The only other way for the US government to get more money is to raise the debt ceiling, right? And now we can issue more treasuries until that ceiling is hit. And then we go through this circus every few years. So in 2019, Fitch actually issued a warning because there was a debt ceiling standoff in 2019. Then in 2020, they issued another warning. And then in 2023, in response to the latest debt ceiling crisis, Fitch placed its AAA rating on a negative watch, meaning just another warning. And then they finally downgraded the US debt on August 1st. Now, as I said, if you followed my last video and if you are in part of our academy, you'll know that I actually issued a warning that this could be the point at which we pull back because we have most of the mega cap earnings concluding this week as of the time of this recording. We printed this insane bearish engulfing candle on the S&P 500 and have traded within it for 3 days after before finally seeing this drop here because of the downgrade. I also cited the fact that it is very common for the S&P 500 to pull back before hitting all-time highs. In 2019, we pulled back 16%. In 2020, we pulled back 8%. And in 2021, we pulled back 8% before hitting all-time highs. Also, I cited that when we switch from a bear to a bull market, we usually see a pullback within a month. We haven't seen that yet in this bull market, followed by the fact that August and September are usually months where we see a lot of red compared to July, which for the NASDAQ, for instance, has been red the last 16 Julys in a row. That is why I issued a hedge warning in the Academy on the 31st. We followed that up by trading neutral strategies on Meta earnings as well as AMD earnings. We traded iron condors for both and managed to pull in over 70% overnight on both of those plays. If you want access to all of my analysis, all of our trades, etc., how I'm maneuvering in the market, what strategies I'm using, because we are very malleable as it relates to the market environment. I truly believe that we are the most versatile group online because we know how to trade everything from options to futures. We know how to trade neutral strategies, negative strategies, positive strategies. And I always keep my finger on the pulse as it relates to the economic environment. And I maneuver my portfolio accordingly. So that is why I issued those hedges. If you want access to all of that, click the link below. Make sure you apply to the Academy. It will be the best investment you ever make if you are accepted. Let's get right back to the video. So like I said, it's baffling that this comes now, especially since the last debt ceiling crisis was already alleviated in May. However, I think that in my view, they are mishandling the power that they have, the rating system Fitch. Remember, I said there were three main ones: Moody's, S&P, Standard & Poor's, and Fitch. So in my view, they are really misusing this power that they have in order to, I don't know, call me conspiratorial, but for me, there's a deliberate reason this comes now, right at the time when it seemed like a market, we were due for a market pullback. And this only puts more pressure on yields as well, because a downgrade of US debt makes yields of all things go up, including mortgages, cars, etc. So along with the Fed interest rate hikes, this puts the economy more under pressure. I mean, I can only think that, there were a lot of stories in the beginning of the year how a lot of money managers were sitting in cash. There was so much cash sitting on the sideline. It was actually a record in terms of calculated cash sitting on the sideline, in the terms of trillions of dollars. And so I can only see this as potentially a way to try to get the market down to a correction in order to load back up into stocks for their clients and for themselves. That's honestly, like, I don't have proof of that, so take it with a grain of salt, but it's hard not to think that, right? When it comes so randomly during the summer, when we typically have slow months, when a pullback or a correction will be a lot easier, and the fact that we were already seeing toppy signals here, right? As a matter of fact, I wrote about this on Twitter yesterday. Follow me on Twitter and Instagram for daily free finance and trading content. You will not regret it. So if you're on both of those platforms, make sure you follow me. Click the link in the description below for my Instagram and Twitter links. But I said Fitch just downgraded the U.S. debt from AAA to AA plus. Last time this happened was August 5th, 2011. The S&P almost fell back into a bear market. We'll talk about the S&P in a second. In my opinion, there was no reason to do this except for to try and force a pullback in the market. In 2011, the downgrade was prompted by the debt ceiling standoff. We already resolved that in May. So as I said, we already resolved it in May. There was no reason to come out and do this now. If they did it back in May, June, that would make sense. But when this happened in 2011, the government was still facing a potential shutdown. Here's the last time the U.S. debt was downgraded. And you could see here that we almost suffered another bear market, right? We were down 19-ish% if you include the wicks. Now, it also is worth bearing in mind that we did have a European debt crisis happening at the same time. But right now we do have an interest rate crisis, right? Which we didn't have in 2011. So, this could bring the market down. Like I said, I was expecting a 5 to 10% correction anyway. So this could bring the market down more than that or within that range. Nobody really knows. It really depends on what the outlook is following this, right? So what is the economy going to do under a rising yields due to downgraded debt and rising yields due to the Fed keeping the rates higher for longer? I was going to wait until Apple and Amazon earnings before opening up major hedges here. I might still do that because as of the time of this recording, Apple earnings and Amazon earnings are tomorrow. So I can afford to wait one more day. But then I will likely open up some hedges. If you want to see exactly what hedges I'm doing, make sure you click the link below and apply to the Academy. And lastly, I'll close with this. It wasn't until 2013 that the S&P upgraded the U.S. debt from from AA plus to AAA. The funny thing that occurred in 2011, I'm just going to leave you with this. So S&P was also, ironically, the rating company that rated the mortgage-backed securities as AAA or whatever. Yeah, I think it was AAA rating, meaning that those subprime mortgages that they packaged as mortgage-backed securities that led to the downfall of the economy in 2008, the great financial crisis. S&P was also one of the rating systems, along with Moody's, that was responsible for naming those mortgage-backed securities as AAA, right? And so when the S&P actually downgraded, immediately after that, the U.S. government commenced an investigation into S&P's role in the rating of several mortgage-backed securities, which played a role in the 2008 financial crisis. And shortly after that, so basically they downgraded the U.S. debt. The U.S. government said, okay, cool, you could do that. You are a private entity at the end of the day. You're not a government agency. But if you're going to downgrade our debt, then we're going to launch an investigation into why you rated mortgage-backed securities AAA. One, you have no credibility. Two, there might be criminality there. And in response to that, just a few days later, Devin Sharma, who was the chief of Standard & Poor's, basically had to step down, and he said that he would leave the company by the end of the year. And obviously he was afraid of prosecution, and they probably made a deal that he would step down. But that was hilarious that they downgraded the US debt, even though they were the same people that had rated mortgage-backed securities, subprime mortgages, as AAA, right? So go figure. It's just one big messed up monopoly board is what it is. Anyway, we will be ready regardless of what happens in the market. We are equipped with the tools to navigate. So I'm not really worried about this. And if we get a pullback, then that will be a welcomed opportunity to go back into blue chips at discounted prices. Anyway, traders, leave a comment down below. Let me know what you think of this. Do you think that the downgrade was warranted? Do you think it wasn't? Do you think that they're playing games? What do you think it was? What do you make of it? Also, regardless of what happens, the U.S. government should probably do away with the debt ceiling process that we have now, where we keep raising the debt ceiling and we keep having a standoff and having to raise it again. No developed country in the world has a debt ceiling. We're the only ones. We should probably do away with it, honestly. But because Republicans and Democrats love to fight, they probably won't. Leave a thumbs up if you got anything out of this video. If I furthered your understanding of what went on with the downgrade, hopefully that was the case. Subscribe to the channel for the best trading and finance content on YouTube. Hit that notification bell. Stay safe out there, traders. Peace.